As of this very second, Friday, November 28, 2025, Nebius Group MV, ticker symbol MBIS on the Nasdaq, is actively trading at $94.41, down fractionally by about 0.3% on the intraday chart, though it has seen significant volatility in the pre-market session where it tested levels as high as $97. If you are watching the order book right now, you are seeing a fascinating battle between profit-taking at the $95 resistance level and a relentless bid from institutional allocators who are treating any dip as a buying opportunity. The volume today is already trending toward the 3 million share mark within the first few hours of trading, signaling that despite the holiday-shortened trading week, the smart money is not taking the day off. Most retail investors look at this chart and see a confusing, jagged line that recently exploded 300% since October. They expect a distressed asset story, a leftover fragment of a geopolitical divorce that is lucky to be listed at all. That is the expectation, a messy, complicated rebound play with too much baggage. But here is the reality, and it is a reality that is currently forcing short sellers to cover their positions in a panic. Nebius Group is not a recovery story. It is currently functioning as one of the purest, most aggressive plays on AI infrastructure shortage in the entire public market. While you were worried about the brand name, they were quietly securing billions of dollars in committed revenue from the biggest tech companies on Earth. When you look closely at the price action of Nebius Group over the last 48 hours, you start to see a pattern that is invisible to the casual observer, but screamingly obvious to anyone who tracks high-velocity capital flows. The stock is not just moving on news, it is moving on scarcity. Every time NBIS dips below $92, we see a shelf of limit orders waiting to absorb the supply. This is characteristic of what we call accumulation distribution, where large entities, think hedge funds or family offices, are building a position without wanting to spike the price too high too fast. This behavior is reminiscent of the early days of Tesla stock, where the narrative was constantly under attack by skeptics, while the underlying order flow told a story of massive accumulation. If you are sitting there with your Schwab Intelligent Portfolios or managing your own individual brokerage account, you might be tempted to look at the RSI, which is hovering near 60, and think the stock is overbought. However, in a supply-constrained supercycle, which is exactly what the GPU clout market is right now, traditional overbought signals often fail. The market is pricing in something that isn't on the balance sheet yet, the sheer desperate demand for compute power that major corporations cannot find elsewhere. To understand why this stock is trading at $94 and not $40, we have to strip away the Yandex legacy that confuses so many people. For years, investors associated this entity with the Russian Google, a search engine giant trapped in a geopolitical quagmire. That narrative is dead. The company you are looking at today, Nebius, is effectively a brand new Dutch startup that just happened to be born with $2.5 billion in cash and no debt. That is a unicorn birth. Most startups in the online investing space, or those touted on Robinhood stock trading forums, have to burn capital for years before they can afford the kind of hardware Nebius started with on day one. When the split happened, Nebius walked away with the international assets, the data centers in Finland, the cloud architecture, and most importantly, the engineering talent that built a hyperscale stack from scratch. This is why the Apple stock comparisons are starting to circulate, not because they sell phones, but because Nebius controls its entire stack. They don't just rent servers, they designed the racks, they wrote the orchestration software, and they optimized the cooling. In the world of AI training, where a 1% efficiency gain can mean millions of dollars saved in electricity, that vertical integration is the secret sauce that the market is currently trying to price in. Let's talk about the specific catalyst that is driving the volume we are seeing today. Recent reports and confirmed filings have indicated that Nebius has secured a massive, multi-year deal with Meta Platforms valued at roughly $3 billion to provide GPU capacity. Pause and think about the magnitude of that. Meta, A company with virtually unlimited resources is turning to Nebius for capacity. This shatters the bear case that Nebius is a second-tier provider. If Mark Zuckerberg's team is signing checks to Nebius, it validates the technical capability of their H100 and upcoming Blackwell clusters. It signals to the interactive brokers crowd and the institutional desks that Nebius is operating at a hyperscaler standard. This deal effectively underwrites their expansion for the next 2 years. It turns speculative growth into backlogged contracted revenue. When a company moves from a hope valuation to a backlog valuation, the multiple expands, and that is exactly the repricing event we are witnessing right now. It is similar to when NVIDIA stock shifted from being a gaming chip maker to a data center monopoly. The market realized the earnings visibility had just extended from quarters to years. However, we need to address the skepticism because it is healthy and necessary. If you go to a Fidelity brokerage forum or read the comments on SoFi Invest, you'll see traders arguing that a $94 stock price for a company that is still technically unprofitable is insanity. They will point to the price-to-earnings ratio, which is non-existent because the earnings are negative, or the price-to-sales ratio, which is astronomically high compared to legacy industrials. This is where the tension between expectation and reality hits its peak. The expectation is that infrastructure is a commodity, that eventually everyone will have enough GPUs and prices will crash. The reality, at least for the next 3 to 5 years, is that compute is the new oil, and we are nowhere near peak supply. The lead times for the newest NVIDIA chips are still substantial, and the complexity of setting up a liquid-cooled data center cluster prevents new competitors from just popping up overnight. Nebius is not selling a commodity. They are selling access to a scarce resource during a gold rush. They are selling shovels, pickaxes, and the water, and they are the only shop open in town that isn't already fully booked by Microsoft or Google for their own internal use. We also need to discuss the Token Factory initiative, which sounds like buzzword soup but is actually a brilliant strategic pivot. Nebius isn't just renting out servers by the hour. They are building a platform for inference, the actual running of AI models after they are trained. This is where the long-term money is. Training a model happens once. Running it, inference, happens billions of times a day. By launching the Token Factory, Nebius is positioning itself to capture the recurring revenue of the AI boom, not just the setup costs. This is why you see Robinhood Investments accounts loading up on fractional shares. The retail crowd is starting to understand that this is an infrastructure play on the usage of AI, not just the creation of it. It's the difference between building a highway and charging a toll for every single car that drives on it forever. The Token Factory is the toll booth. Now, I want to take a moment to ask you something because the sentiment on this stock is so polarized. Comment below how many shares of Nebius you currently hold, or if you are waiting for a dip to enter. Do you think the connection to its Yandex past is a liability, or is the market totally over that by now? I really want to know if you trust the management team led by Arkady Volozh to navigate this new European chapter. Continuing with the analysis, let's look at the technical setup on the chart for the traders using Thinkorswim or interactive brokers trading platforms. We are currently sitting above the 20-day exponential moving average, which is a bullish sign of momentum. However, there is a clear supply zone between $96 and $98. Every time the price pushes into this area, we see wicks on the candles, indicating selling pressure. This is likely early investors from the resumption period taking profits. For the stock to break out past $100, a massive psychological barrier, we need a volume catalyst. That catalyst could come in the form of the next earnings print, where they reveal the full impact of the Meta deal on their cash flow, or it could come from a new partnership announcement, perhaps with a European giant or another member of the Magnificent Seven. Until then, the stock might consolidate here, building a base that sets up the next leg higher. Smart money likes bases. They dislike vertical lines because vertical lines usually collapse. A consolidation around $94 is actually the healthiest thing this stock can do right now. Let's shift gears to the macro environment. You cannot analyze Nebius Group NV without looking at the broader semiconductor and energy landscape. Tesla stockholders know this better than anyone. AI requires power, gigawatts of it. Nebius has a distinct advantage here with its Finnish data center heritage. They are accustomed to operating in environments where cooling is efficient and power is relatively green. As regulatory scrutiny heats up in the U.S. regarding data center power consumption, having a European footprint with high-efficiency standards becomes a strategic moat. It mitigates the regulatory risk that is currently hanging over some of the U.S.-based miners and data center REITs. Furthermore, the European Union is desperate for sovereign AI, the idea that Europe shouldn't be entirely dependent on U.S. tech